put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The day Wall Street died. September 15th, 2008, 1:45 a.m. The lights were still burning on the 31st floor of 745 7th Avenue in Manhattan. Inside, men in $1,000 suits were shredding documents. Outside, a crowd was gathering, traders, journalists, and curious onlookers who sensed that something catastrophic was unfolding. By sunrise, the fourth largest investment bank in America would be dead. But this wasn't just a bankruptcy. This was an execution, and the weapon that killed Lehman Brothers had been forged in its own boardroom years earlier, in decisions made behind closed doors by men who believed they were untouchable. Tonight, we're going to pull back the curtain on one of the darkest chapters in financial history, a story of greed, deception, and the catastrophic collapse that nearly destroyed the global economy. This is the real story of how Wall Street died. The year was 1850. 3 German immigrants, Henry, Emmanuel, and Mayer Lehman, opened a small dry goods store in Montgomery, Alabama. They traded cotton, the white gold of the South, and slowly built an empire from the red clay soil of the American frontier. By the time the 20th century arrived, Lehman Brothers had transformed itself from a regional commodity trader into a Wall Street powerhouse. They survived the Civil War, the Great Depression, 2 world wars, and countless market crashes. For 158 years, the name Lehman Brothers meant stability, prestige, and old money respectability. But empires built on reputation can crumble when reputation becomes a mask for something darker. In 1994, a man named Richard Fuld became CEO of Lehman Brothers. They called him the Gorilla, not as a term of endearment, but as a warning. Fuld was known for his intimidating presence, his volcanic temper, and his ruthless approach to business. Employees whispered stories of him tearing phones from walls during angry outbursts, of careers destroyed with a single glare. But Fuld had a vision. He wanted to transform Lehman Brothers from a respected investment bank into the most aggressive, most profitable financial institution on Wall Street. And for more than a decade, it worked. Under Fuld's leadership, Lehman's stock price skyrocketed. Profits soared into the billions. By 2007, Lehman Brothers reported record earnings of over $4 billion. Fuld himself became one of the highest-paid executives in America, earning nearly $500 million during his tenure. On the surface, it looked like pure corporate genius. But beneath the gleaming tower and the champagne celebrations, a cancer was growing. The poison had a name: subprime mortgages. In the early 2000s, the American housing market became a feeding frenzy. Banks were lending money to anyone with a pulse, people with no income, no jobs, no assets. These loans were called subprime because the borrowers had poor credit and high default risk. But Wall Street had discovered a dark kind of alchemy. They could bundle these toxic loans into complex financial products called mortgage-backed securities, slap a AAA rating on them, and sell them to investors around the world as if they were Fort Knox gold. It was financial fraud disguised as innovation, and Lehman Brothers dove into the pool deeper than almost anyone else. By 2006, Lehman had amassed over $40 billion in mortgage-related securities. They weren't just selling these products, they were gorging on them themselves. The firm's leverage ratio, the amount of borrowed money compared to actual capital, had ballooned to an astronomical 31-to-1. That meant for every dollar Lehman actually owned, they had borrowed 31 more. It was like building a skyscraper on a foundation of sand. One tremor, and the entire structure would collapse. Inside Lehman's risk management department, Warning signals were flashing red. A senior risk officer named Madeline Antonsich repeatedly raised concerns about the firm's massive real estate exposure. She was ignored, marginalized, and eventually pushed out. Other executives who questioned the strategy found themselves sidelined or fired. Fuld and his inner circle had created a culture where dissent was dangerous and risk was rewarded. They were making too much money to stop, and the clock was ticking. In early 2007, the first cracks appeared. Home prices, which had been climbing for years, suddenly stopped rising. Then they began to fall. Borrowers who had taken out adjustable-rate mortgages, loans with low initial payments that ballooned after a few years, started defaulting in massive numbers. The entire subprime market was collapsing. Bear Stearns, another major investment bank, reported that 2 of its hedge funds heavily invested in subprime mortgages had lost nearly all their value. Wall Street's alarm bells were ringing, but Lehman Brothers pressed forward, eyes closed, fingers in their ears. In August 2007, just months before the crisis would reach critical mass, Lehman Brothers doubled down. They purchased a company called BNC Mortgage and another subprime lender for billions of dollars. It was corporate suicide, disguised as expansion. And here's where the story turns truly dark. Inside Lehman Brothers headquarters, executives knew the firm was sitting on a mountain of worthless assets. But rather than come clean, they chose deception. The scheme was called Repo 105, and it was accounting fraud dressed up in legal language. Here's how it worked. At the end of each financial quarter, when Lehman had to report its financial health to investors and regulators, the firm would temporarily sell tens of billions of dollars worth of toxic assets to other companies with an agreement to buy them back a few days later. This wasn't a real sale. It was a shell game. But because of how the transactions were structured, Lehman could classify them as sales rather than loans, which meant they could remove these assets from their balance sheet temporarily. This made Lehman appear far less leveraged and far healthier than it actually was. Between 2007 and 2008, Lehman used Repo 105 to hide approximately $50 billion in troubled assets. $50 billion. Investors, regulators, and rating agencies were all being lied to on a massive scale. And at the center of it all was Richard Fuld, the man who had built his reputation on toughness and dominance, now presiding over one of the greatest frauds in financial history. But the lie couldn't last forever. By March 2008, the financial system was in full panic mode. Bear Stearns collapsed and was sold to J.P. Morgan Chase for pennies on the dollar in a government-orchestrated fire sale. It was a preview of what was coming. Lehman Brothers stock, which had been trading above $80 per share a year earlier, was now plummeting. Hedge funds and institutional investors began pulling their money out. The firm was bleeding billions in capital every week. Richard Fuld went into crisis mode, desperately searching for a buyer, a partner, anyone who could inject capital and save the firm. He reached out to Warren Buffett, the legendary investor known as the Oracle of Omaha. Buffett's team examined Lehman's books and walked away. The rot was too deep. Fuld approached the Korea Development Bank, promising them a stake in one of Wall Street's most prestigious names. The Koreans declined. He called Bank of America. He called Barclays. He called everyone he could think of, begging, threatening, pleading for a lifeline. But the truth was out. Lehman Brothers was doomed, and everyone on Wall Street knew it. In the summer of 2008, Lehman reported a second-quarter loss of $2.8 billion, the worst quarterly loss in the firm's history. The stock price collapsed to single digits. Inside the building, employees were in shock, watching their life savings evaporate as their company stock became worthless. Outside, protesters gathered with signs calling Lehman executives thieves and criminals. And in Washington, Treasury Secretary Henry Paulson, himself a former Goldman Sachs CEO, was facing the most critical decision of his career. Just months earlier, the government had bailed out Bear Stearns to prevent a wider financial contagion. Now, with Lehman Brothers on the brink, Paulson had to decide. Would he use taxpayer money to save another Wall Street giant? Or would he let Lehman fail and teach the markets a lesson about moral hazard? It was a choice between two evils, and the clock was running out. What happened next remains one of the most controversial decisions in modern financial history, and it carries a dark secret that most people still don't know. On the weekend of September 13th and 14th, 2008, Paulson summoned the titans of Wall Street to the New York Federal Reserve Building. The CEOs of Goldman Sachs, J.P. Morgan Chase, Morgan Stanley, Merrill Lynch, and others gathered in a wood-paneled conference room. The message was clear. Find a private sector solution to save Lehman, or the government would let it die. For 48 hours, these men, who spent their careers competing against each other, negotiated frantically, trying to structure a deal that would prevent total collapse. Bank of America briefly considered acquiring Lehman, but ultimately chose to buy Merrill Lynch instead, leaving Lehman to twist in the wind. Barclays, the British bank, was interested, but UK regulators refused to approve the deal without guarantees from the US government. And Henry Paulson, whether out of principle, politics, or miscalculation, refused to provide those guarantees. But here's the dark secret. Many insiders believe Paulson made a deliberate choice to let Lehman fail. Some say it was to send a message that Wall Street couldn't expect endless bailouts. Others whisper something darker, that Goldman Sachs, Paulson's former firm and Lehman's fierce rival, stood to benefit from Lehman's death. With Lehman gone, Goldman would have less competition and could swoop in to claim Lehman's clients, assets, and market share. Whether this conspiracy is true or not, the outcome was the same. On Sunday, September 14th, at 11 p.m., Lehman Brothers lawyers filed for Chapter 11, bankruptcy protection. It was the largest bankruptcy in American history. Over $600 billion in assets vanished overnight, and the shockwave that followed nearly destroyed the world. Monday, September 15th, 2008, became known as Black Monday. Global stock markets went into freefall. The Dow Jones dropped more than 500 points. Credit markets froze. Banks stopped lending to each other, terrified that the next Lehman was lurking around every corner. Within days, AIG, the massive insurance company, teetered on the edge of collapse and had to be bailed out by the government for $85 billion. Washington Mutual, the largest savings and loan in America, failed. Wachovia Bank nearly went under. Iceland's entire banking system collapsed, and the country went bankrupt. The global economy was spiraling into the abyss. Unemployment soared. Millions of people lost their homes, their savings, their retirement funds. Small businesses closed by the thousands because they couldn't get credit. The Great Recession had begun, and it all traced back to that September night when Lehman Brothers died. Inside Lehman's former offices, the scene was apocalyptic. Employees who had arrived for work that Monday morning were told to pack their belongings and leave immediately. Some wept openly at their desks. Others walked out carrying boxes filled with personal items and shattered dreams. 25,000 people lost their jobs in a single day. And what about Richard Fuld, the man who had steered the ship into the iceberg? He walked away with nearly $500 million in compensation earned during his time as CEO. Money extracted from a company he had destroyed. In October 2008, Fuld was called to testify before Congress. Lawmakers grilled him, accusing him of greed, recklessness, and fraud. Fuld sat stone-faced, offering no apologies, no remorse. He blamed the crisis on short sellers, on regulators, on market forces beyond his control, but never on himself, No criminal charges were ever filed against Fuld or any other Lehman executive. The justice system, it seemed, had no appetite for prosecuting the architects of the financial crisis. The collapse of Lehman Brothers taught the world several brutal lessons about power, greed, and the dark machinery of modern finance. First, leverage is a double-edged sword. Borrowing massive amounts of money can amplify your gains, but it can also amplify your losses to catastrophic levels. Second, institutional culture matters. When a company rewards recklessness and punishes dissent, disaster becomes inevitable. Third, regulators and rating agencies failed spectacularly. The very institutions meant to protect the financial system were either asleep at the wheel or complicit in the fraud. And finally, there's the darkest lesson of all. In the world of high finance, the people who cause the most damage rarely pay the price. They walk away rich, while millions of ordinary people suffer the consequences. Today, the name Lehman Brothers exists only as a cautionary tale, a ghost story told in business schools and financial documentaries. The firm's former headquarters in New York has been rebranded, its logo scrubbed from the building. Richard Fuld lives in obscurity, a pariah on Wall Street, but still insulated by enormous wealth. The global economy eventually recovered, but millions of people never did. Families who lost their homes, workers who lost their careers, retirees who saw their pensions evaporate. These were the real victims of Lehman's collapse. And the system that allowed it to happen. It's still in place, still operating by the same rules, still driven by the same incentives. Wall Street survived, but it learned the wrong lesson. Not that greed is dangerous, but that if you're big enough and connected enough, someone will always bail you out. Lehman Brothers was the exception that proved the rule. September 15, 2008, was the day Wall Street died. Not literally, of course. The stock market still opens every morning. Traders still shout on the floor. Billions still change hands with the click of a mouse. But something fundamental died that day. The illusion of stability. The myth of too big to fail. The belief that the masters of the universe knew what they were doing. Lehman Brothers fell not because of bad luck or unforeseeable circumstances, but because of choices. Deliberate, calculated decisions made by men who valued short-term profits over long-term survival, who prized arrogance over prudence, who confused leverage with genius. And in the end, they built a 158-year-old empire into a house of cards, then struck the match themselves. If you walk past 745 7th Avenue in Manhattan today, you won't find any trace of Lehman Brothers. The building stands silent, occupied by other companies, other ambitions. But on quiet nights, some say you can still feel it. The ghost of that September morning, the moment when everything changed, when the world woke up to discover that the most powerful financial institution in America had vanished overnight. And somewhere in that darkness, a question still whispers, if they could fall, who's next? Subscribe and listen to our next story below.